Okay, we are back once again with another Coffee Microcaps fund manager interview, and I'm delighted to say we're welcoming back for the second time Mike Younger and Richard Ivers from Prime Value. Gentlemen, morning.
Good morning.
Uh,
Morning,
nervous
Mark.
look, nervous look on both their faces as we're recording this just as we're out to head into reporting season. So hopefully there'll be no bums in the portfolio and we'll get out
Mhm.
this time in March, all well and good. But for anybody who maybe didn't catch our first interview, which was back in October, I think, or maybe November, um, Mike or Richard, whichever one of you wants to maybe just give a quick overview of Prime Value and the microcap fund, because while the fund has been around for a while, a couple of years now, the retail share class only opened up in this last financial year, so 1st of July. So maybe just give a quick overview to people of what you guys do with Prime Value and more specifically the microcap fund.
Okay, I'll have a crack. So Mike and I are the joint portfolio managers of the Microcap Fund, as you said, Mark, and along with Ben Melody, who's not on the line today, but is the third member of our team. We also, as a team, manage a small cap fund called the Emerging Opportunities Fund here at Prime Value. Both funds have done really well. We're called Prime Value, but we're not actually a value fund. We're more style neutral with maybe a GARP type bias. And the performance is there's been strong returns over the 8 years or so that at least one of us has been here managing the fund. But we're also well known for taking a relatively low risk profile. So we're generating returns above market, but doing it at one of the lowest risk profiles of any of our peers. So playing in an asset class that's relatively volatile, but provides the opportunity for very, very high returns because it's a less efficient part of the market, and we're doing it in a way that reduces that volatility. So trying to provide somewhat the best of both worlds, high returns and lower risk. And as you said, yeah, we launched the retail version of the Microcap Fund in July last year of 2025, and its first 6 months of operation through to 31st of December returned just over 18% after fees. So it's had a really good start to life. And we've actually been managing that for 8 years prior to that. But that's the initial retail version, which is open to the broader public.
Okay, perfect. And yeah, as you say, 18% over the first 6 months, nothing to be sneezed at in that class. It's been quite maybe just a quick take on where do you think is where we are in the microcap space more broadly before we jump into the two stocks. 2025, I think a standout year, more standout depending on how much exposure you had to the resources sector. But kind of as we head into reporting season, as we head into 2026, if we take a kind of a longer view. Are we expensive? Are we fair value? Is it getting a bit harder to find new names or new names that look attractive from a valuation perspective?
Yeah, it's an interesting juncture, as it always tends to be in markets. With what we're seeing is very strong earnings growth coming from the micro cap space. And so what might have looked like quite an expensive multiple on the sector going back a year ago, it actually looks relatively cheap now, or at least below long-term averages. Part of it, I think, in recent months has been, as you've seen, extremely strong growth coming through in the resources space. That seems to have been funded to a degree by selling off of industrial companies. Our focus is entirely industrials. We don't own resource companies. And so a lot of these companies have been sold down to levels that do look really quite cheap. And so when we look at the fund, we think that the stocks we own tend to be above average quality. But the PE on our microcap fund looking forward is about 15 and a half times.
Okay. Yeah. Yeah, I think that has been a kind of a noticeable even from my point of view, looking through a lot of names, the surprising part, despite what everybody says about the economy in the microcap space, is kind of how well the earnings has held up, especially even on the more domestic focused names. And we've got two domestic focused names you picked out for us for this morning. The first one is Motorcycle Holdings, a distributor of many a brand. Harley Davidson obviously being a big one, but they do lots of others as well. But Mike, for anybody who hasn't kind of looked at the stock or looked at it in more recent times, maybe just give us the quick 101 on what Motorcycle Holdings do.
Yeah, sure. So, as you mentioned, and as the name suggests, they're the largest retailer and wholesaler of motorcycles and ATVs, or all-terrain vehicles, which essentially are quad bikes in the country. And so they make money from selling new bikes, used bikes, as well as motorcycle parts and accessories. And there's a few other little ancillary revenue lines like finance and insurance as well. The key brands for this company is Harley Davidson, which is by far and away the highest margin motorcycle in the industry, as well as a lesser known brand to the average Joe out there in CF Moto, which is becoming the leader in all-terrain vehicles in the country, and especially into the industrial space and the agriculture sector. And so it's a business which, the industry itself can be cyclical, where sales can ebb and flow over time through the business cycle. But this company's got a really strong record of gaining market share. And so when you go back to fiscal 20, just prior to COVID, their market share of new motorbike sales in this country was about 11%. And that made them the largest player at 11%. And in the year just gone, it was 17%. So they've had really consistent growth in market share. And the acquisition that they made recently of the second largest player takes them now to a share of over 20% of sales across the country.
And is that what kind of attracted you to the story, that acquisition? I remember the acquisition. I think they were buying a business actually out of administration, so I'm sure they got it for a knockdown price at the time. But was that kind of a catalyst? Obviously, like any distribution business, it doesn't matter whether we're talking about motorcycles or anything else. If you push through more volume on a relatively fixed cost base, it spits out a decent earnings number down the bottom.
Yeah, no, we actually invested prior to that. And the catalyst for us was just observing this CF Moto brand in particular continuing to outgrow the industry. And so when I spoke of that market share gain that the business has had over time, a reasonable amount of that actually comes down to CF Moto. So CF Moto is a Chinese all-terrain vehicle brand. So you can sort of think like a BYD in the auto space, but in all-terrain vehicles. And so Motorcycle Holdings has the distribution rights for Australia and New Zealand for CF Moto. And this business has just gained material market share to the extent that it's now rivaling for number one market share in the country. And it's been a real disruptor because it's effectively offering good quality bikes at quite discounted prices to where the prevailing brands operate. And so observing that market share growth to us signaled a shift that this is becoming less of a cyclical business and more of a structural growth story. And then what's happened since is, as you mentioned, they've acquired Peter Stevens and Harley Heaven. And so Peter Stevens and Harley Heaven, they were effectively the second largest player in the market. As you mentioned, they went into administration and the business has been split up. Motorcycle Holdings bought about 60% of the dealerships and another player acquired about 40% of those dealerships. And it's a really material acquisition for them. Harley, as I mentioned, is the highest profit margin bike in the country. And so the market share now that Motorcycle Holdings has in that space for Harley is about 45%. So 45% of all Harley dealerships are now Motorcycle Holdings. And so if you're in New South Wales, for example, from Sydney all the way out to Newcastle, every single one of those dealerships is now a Motorcycle Holdings dealership. So it's a really strong strategic acquisition. They bought it out of administration. So the actual acquisition price on the capital they paid was about $8 million or so, and another couple of $1 million on inventory. And we think that within a couple of years, they should be able to earn $3-4 million of net profit after tax from those assets. So they bought them at
circa 3 times earnings. And then you've got synergies that will come out on top of that. And so things like used bikes, Motorcycle Holdings now has an extra base from which to be able to distribute used motorbikes. The finance and insurance business that they own in a joint venture, they'll be able to offer that now across the Peter Stevens and Harley Heaven businesses, as well as the accessories that they sell. There is Peter Stevens and Harley Heaven predominantly source their accessories from another supplier. And so that will switch across to the Motos brand. So there's a number of very tangible synergies that we see coming through, which means that this acquisition is likely to prove at least 15, maybe 20% EPS accretive on its own. And that's without then considering the longer lasting benefits of industry rationalisation.
And in terms of, I know that we've got the result coming up now in February, but as you say, it's more of a structural growth story. It's not so much about this result. It's kind of integrating Peter Stevens, because that was only, I think, like mid last year, if I remember the timing correctly. You know, there's that kind of the full 12 months, 24 months kind of cycle through by the time they, you know, work through the proper integration and realize synergies that you've spoke about. Um, on the CF Moho business, that agricultural, industrial, maybe even side of it, is that less cyclical to, you know, what's happening in ag, because, you know, the underlying customer also is in a very cyclical industry, or is it, you know, does it help kind of dampen out the more retail Harley business overall?
Yeah, it absolutely is less cyclical than the traditional business, the legacy motorcycle retail business. And in fact, while the company's profits have been ticking along quite nicely in recent periods, it's really been driven by CF Moto, and so the retail business is undergoing a turnaround in real time, if you like, and the profit before tax margin is tracking around. I'm just thinking off the top of my head, it's only like 1.5% or so. And that really should be, when we look out to the medium term, these businesses should be more like a 3% pre-tax margin. The Harley dealerships alone, they're probably closer to 4 or even 5. And so there is a real recovery story that we think will come through the retailing side, albeit it's going to take a couple of years to reorganise.
Yeah, as you say, the 3% margin would be, you know, something akin. People who maybe follow on the car side, AP Eagers, will be, you know, kind of used to seeing that kind of margin on a pretty regular basis. And I know, you know, every stock story has a few warts to go with it, and one I think it's worth mentioning on Motorcycle Holdings is an issue they've picked up themselves, actually, with vehicle registration fees that have to be paid to various state governments. They've found a kind of a billing error or collection error that now needs to be resolved with all of the various state revenue agencies in terms of collection. So that, I mean, there's a kind of a one-off hit that's going to come through at some stage, probably at the back end of FY26. I think they're still working through the numbers, but maybe I think just touch on that for people, since we haven't spoken about it.
Yeah, that's right. And this has arisen through complexities in systems and acquisitions that have been made over time. But ultimately, I mean, we're viewing this as a P of one type event, and the likely impact, we don't know what it will be necessarily, but the likely impact's going to be in the sort of mid-single digit millions of dollars that they may have to pay. So in the context of the broader investment thesis, it's a very small negative.
Yeah, I think it sounds like a billing error, computer bug somewhere that you know, has only kind of come to light now. So I think a lot of companies say a one-off, but I think in the context of this little hiccup in the story, I think it is probably as true a one-off as you're going to get.
Yeah, indeed.
point. Certainly interesting name to look at. As you say, margins, around the 1% mark. That's a long way off where the AP Ivers guys, if people want to look at what's kind of a comparable business in a different vertical might do. But we're going to switch gears entirely here for Richard's stock, and that is another business been around for very long time. A kind of a play on the resources sector to a certain extent without actually mining anything, and the Fleetwood business, Richard.
That's right. Yeah, it's mining exposure. That's right. Along with sort of housing, if you like, broader housing exposure, and trying to solve or help with the whole housing crisis. So they've got three main divisions. If I might go through it, Mark, if that's all right.
Yeah.
So three main divisions. The one I think you were alluding to earlier is community solutions, whereby they own a site called Cerebral Village, which is basically housing for FIFO workers, so people who are coming in to help with, the mine, just located up in the Pilbara, in a place called Karratha, and they contract out to the likes of Rio Tinto, where you might have people coming in and working on the mines, or doing maintenance of those mines, shutdown and maintenance work, and they'll come in and they'll stay at the Cerebral Village. It's a very high incremental margin on this revenue for Fleetwood, in that it's a very fixed cost business. So it's all about occupancy, about filling up the rooms and getting paid per night, per room, and the higher occupancy, obviously, the higher profit that comes through. So that's the key part of the business, and that's actually doing very well, and has got good visibility over the next sort of 12-18 months at least, because it's contracted out to particularly Rio, which is taking up a large proportion of those rooms. So this year should be about 85% occupied, contracted, and they've got good visibility into FY27 as well. So that's the first of main division. Then you've got building solutions, whereby they actually manufacture buildings. So think of a modular, prefabricated type housing, and classrooms for education and the like. And that's a cheaper, more efficient way of constructing housing, rather than relying on tradies and the like to turn up on site. You're constructing it in a manufacturing facility. It's quicker, simpler, more efficient. You've got all the workers there, and then you can then deliver it and install it on site. So that's a business that's in a bit of a turnaround. Its margins are well below what they could potentially be. But when I talk to you about the investment case and how the valuation stacks up, we think that's really an upside to the valuation. So we're not incorporating that turnaround coming through yet. It still stacks up. And then you've got RV Solutions, which is more for the likes of providing services and products for the caravan market. So bits and pieces that people need to, replenish the caravans that they own. And that business has sort of struggled for a while. They've shut down manufacturing, and we just think about that at book value. So basically the value of the inventory that they hold, which is priced at wholesale prices, not the retail price they'll sell it off. So arguably relatively conservative as well. And then the investment case is essentially that the market cap's around $250 million. They've got about 50 million of cash. They've got some land in Perth, which is they have some manufacturing on, but it's right and well located in Perth near the airport, and they could easily sell that off, and that's valued at least 25 million conservatively. And they could relocate the facilities there somewhere else to much cheaper. And then you've got RV, as I said, just valuing that at book value at about 25 million. So you add those three components up together, that's about 100 million of assets. Take it off the market cap of 250, and you're paying about $150 million for the Cerebral Village and the building solutions, which is generating about 40 million of EBIT. So you're paying less than 4 times for the business. Now, the other interesting thing that your viewers might like is that they pay out pretty much 100% of their earnings in dividends. So they should pay a dividend of somewhere around 29 cents a share, we think, this financial year. The stock's trading about $2.70, so you're getting a yield of about 11% for the year, fully franked. So franking on top of that 11% as well. So you're getting it cheap, but you're getting paid a really good return while you wait.
Yeah, it's worth calling it out, because anytime we do have companies presenting the hard dividend paying, there's not many down in the microcap space. So if you're looking for a bit of income within a broader microcap portfolio, this is one probably definitely to maybe run the rule over. In terms of other catalysts, Richard, I know for years people have always wondered about why they hold on to the RV business. It seems most less synergistic, or the one that doesn't really, building solutions and the other, you could say, you could kind of got, and the community business, you can say, are kind of two separate businesses of half decent scale as well in my head, that you could just operate Fleetwood with like that, and the RV business could go somewhere else. They haven't mentioned anything about divesting it or selling it off. Are they still pretty much committed to keeping the three divisions?
I think they're open minded, like all listed companies. I mean, the business is for sale every day because it's listed and anyone can come in and buy stock. But I think they're open minded about any business they own, as all listed companies should be. And I think for the moment they are holding on to that business, but it's definitely one that strategically, like you said, probably doesn't naturally fit within the business. So if it got a reasonable price, I wouldn't be surprised that if it got sold off. Although they haven't said that publicly yet.
Yeah. And for kind of similar to Motorcycle Holdings, as I say, results are coming out now, but over the course of 2026, what are you kind of looking from Fleetwood? Is it that continued turnaround to add incremental margin in the buildings business, or is there potential? You said it's around 80% occupancy, which is quite high, because Sea Ripple's occupancy can be 80% one year, can drop to 30% or even lower in the depths of a resources recession, or if there's kind of a big piece of work is kind of completed and now they don't need as many staff on site up there. Can they push it higher into the 90s occupancy up there?
I think it's unlikely it'll go to just relatively high for at least the next 18 months and potentially longer. I mean, you have visibility out sort of 12, 18 months, and then you get more contracts that renew, and then you get more visibility beyond that. So it's kind of a rolling contract renewal type business. I know in the depths of the previous downturns, it did get relatively low occupancy, but there's been new projects starting up in the regions, including Perdaman, the new mine there. So that's means that there's more demand for the site, and there's arguably a much higher shortage of accommodation in the area. So we'd be surprised if we ever got down to those levels again. So but to answer your question, what are we looking for the results? Yeah, it's about that contracting level for the community solutions business, and giving further visibility longer term, so you can see that earnings continuing to grow, potential price increases coming through as well. And then the turnaround in the building solutions business, as I said, we're incorporating only 40 to 45 million EBIT for the combined community solutions and building, and the vast majority of that is the Sea Ripple. So any upside to building could potentially move the dial quite a lot, because they do about 350 million revenue. You could get margins up towards 7% for that business, but it's been down at sort of 2-3% for a little while. So a doubling of margins in that business over the longer term provides a significant amount of upside. So it's how that plays out. And then as you mentioned earlier, the RV, what are they going to do with that? They've been pretty committed to strong capital management at the board level. So 100% payout, as I said, focused on return on capital, which we like all of those things. They're good shareholder friendly type things. So continue to talk about that and targets, which will help to give clarity on future returns. And then they've had a new CEO join, and that will be interesting as well, Andrew Pidcock, which will be facing the market. Should be facing the market for the first time this result season.
Yeah, he started this month, or maybe it was the 1st of January. So it'd be interesting to hear his take on how he sees the business. I'm sure he presented a strategy to the board as part of the selection process. So it'd be interesting to hear him or what comes into the slide deck, if there's any nuances and changes of of strategy under a new CEO. It's always interesting to hear. Richard, Mike, thanks very much for joining us. I think yeah, two interesting names to look at for 2026 and beyond. By the sounds of both of them, they're got stories that continue on well beyond the next 3 weeks in terms of where the businesses can develop into. So thanks very much for joining us, and we'll catch you hopefully maybe later on in the year. Maybe we can touch base again maybe around the full year results.
Sounds good.
Thanks, Mark. Really appreciate it.
Thank you.